Hey friends, welcome back to Mortgage Ballers. Today we're going to talk about something that's super important: how the mortgage bond market works, how it affects the mortgage rates you see when buying a home. We're going to tie in the 10-year treasury bonds as well. Sounds tricky, but don't worry, I'm going to make it simple and fun. You ready? Who writes this stuff? Okay, first things first, let's talk about what's a mortgage. A mortgage is a loan that you get when you want to buy a house. So instead of paying all the money for the house at once, you borrow money from a bank or lender and you pay them back little by little. Now, the cool thing is when you borrow money, you don't just pay back the original amount, you also pay back something called interest, right? Interest is like that little thank you gift that you pay your lender. Now, where does the interest rate come from? The mortgage bond market plays a huge role in this, and let me try to explain that a little bit better. All right, imagine the bond market is like a huge market where investors go to buy and sell bonds. First question, what is a bond? A bond is like a promise. When an investor buys a bond, they're lending money to someone. And in case of a mortgage bond, the investor is lending money to banks and lenders. In return, the bank promises to pay them back plus a little extra in interest. Now, here's the interesting part. The price of these mortgage bonds can go up and down based on a lot of things. When bond prices go up, mortgage rates go down. When bond prices go down, mortgage rates usually go up. It's kind of like a seesaw. Higher bond prices mean lower interest rates for mortgages, and lower bond prices mean higher interest rates. You follow me so far? All right. So what makes the bond prices go up or down? That's the million-dollar question. Well, the answer, a lot of things. But let's talk about a few of the big ones. First thing that we look at is economic news, and that is a big deal. If there's good news like more people are getting jobs or companies are doing great, investors might feel like they don't need to buy bonds as much. This can make bond prices go down, which makes interest rates go up. And the opposite is true with the news. But if there's bad news, like a lot of people losing their jobs or the economy not doing well, investors may rush in to buy bonds because they feel it's a safe place to put their money. When this happens, bond prices go down, mortgage rates go up. Now, another thing that can affect the bond market is something called inflation. Now, inflation, we've heard that word a billion times, right? It simply means that the prices of things are going up over time. If people think inflation's on the rise, bond prices can fall and mortgage rates can actually go up. It's like when everything in a store gets more expensive, you may not want to buy as much stuff. Well, investors may not want to buy as many bonds if they think the prices are going to keep going up. So inflation is a huge factor, and we've all heard it, and that's probably been one of the leading indicators for rates over the last 3 years. Also, remember this, the 10-year treasury, that's like the big boss of the bond market. When investors look at bonds, they often compare everything to the 10-year treasury bond because it's considered the safest bond out there. If the 10-year yields go up, then mortgage bonds usually follow along, which means mortgage rates go up. If the 10-year bond yields go down, mortgage rates might go down as well. Key there, the 10-year treasury moves in the same direction as rates. The one thing about this process that is probably most important is to remember that regardless of the data that you get from the labor statistics or the inflation, the CPI, the PPI, and the PCE, we have all these reports that we look at, and we try to use these reports to help us predict where rates are going to go. And even with all that said, nobody really knows for sure what's going to happen. So keep that in mind. But there's another factor that needs to be talked about, and that is the Fed sentiment. So when the Fed chair is presenting the information, we're looking for a sentiment of optimism or a sentiment of pessimism. Sometimes the data that is given to us to help determine which way investors are going to go is impacted as much by the data as it is by the delivery of the information. In order for us to help our clients get the best rate and time the market, because timing is really everything, we try to look at those factors and we hope it's accurate. But then we also look at what was the tone that the Fed delivered it in? Was it one of optimism or was it one of kind of Debbie Downer? Look at these factors, put it all together and make a guess. That's what the best investors are doing. Well, that's it for today, guys. We'd love to hear back from you. Don't forget to like and subscribe and leave a comment below. Have a great day.